Welcome to the New York City Bar Association podcast. Opinions expressed are those of the speakers and not necessarily of the City Bar.
Hello, everyone, and welcome to another podcast hosted by the City Bar Task Force on Digital Technologies. My name is Jerome Walker. I'm a co-chair of the task force. Unlike in the majority of financial institutions in the U.S., insurance is regulated and supervised exclusively by the states, except where the Financial Stability Oversight Council, FSOC, has designated an insurance company holding company as a systemically important financial institution pursuant to Section 113 of the Dodd-Frank Wall Street Reform and Consumer Protection Act. To date, the FSOC has only designated 3 such entities and subject those entities to the supervision of the Board of Governors of the Federal Reserve System and enhanced prudential supervision. FSOC subsequently rescinded 2 of those designations, and now only 1 such entity is subject to the supervision of the Federal Reserve and enhanced prudential supervision. While insurance departments directly supervise and regulate insurance companies, a significant amount of guidance for insurance companies is provided by the National Association of Insurance Commissioners, or NAIC. For instance, NAIC provides expertise, data, and analysis for insurance commissioners to regulate the insurance industry. Since NAIC is a standard-setting organization, it is governed by the chief insurance regulators from the 50 states, the District of Columbia, and the 5 U.S. territories to coordinate the regulation of multi-state insurers. According to NAIC, in the insurance industry, artificial intelligence is transforming areas such as underwriting, customer service, claims, marketing, and fraud detection. NAIC, for example, has pointed out that AI is currently used in claims processing, underwriting, fraud detection, and customer service, and many insurers are using virtual assistants like chatbots to improve customer experience. According to NAIC, those chatbots are available all day, every day, to give basic advice, check billing information, and address common inquiries and transactions. NAIC also points out that insurers currently using chatbots include name brand insurers such as Geico and Allstate. In addition, NAIC emphasizes that claims management can be augmented using machine learning techniques in different stages of the claims handling process, and machine learning models can help quickly assess the severity of damages and predict the repair costs from historical data, sensors, and images. In August 2020, NAIC adopted principles on artificial intelligence, which recommends that insurance companies and all persons or entities facilitating the business of insurance that play an active role in the AI system lifecycle, including third parties such as rating data providers, advisory organizations, promote, consider, monitor, and uphold certain principles based upon their respective roles. While these principles are guidance and do not carry the weight of law or impose any legal liability, the principles may serve to inform and establish general expectations for AI actors and systems, emphasizing the importance of accountability, compliance, transparency, and safe, secure, fair, and robust outputs. Today's podcast will explore AI-enabled underwriting and the range of issues raised by a proposed insurance circular letter regarding the use of artificial intelligence systems and external consumer data and information sources in insurance underwriting and pricing, issued on January 17 by the New York State Department of Financial Services. I'm very pleased to introduce 2 members of the task force and one of the leading experts in artificial intelligence and insurance. The 3 of them will help make sense of artificial intelligence and insurance. In alphabetical order by last name, our guests include Sophia Duffy. Sophia is an attorney and an associate professor of business planning at the American College of Financial Services. Azish Filabi. Azish is also an attorney and a co-chair of the Task Force Subcommittee on Artificial Intelligence. She's also the executive director at the American College Carrie M. McGuire Center for Ethics in Financial Services and the Charles Lamont Post Chair of Business Ethics and an associate professor. Corey Goldstein. Corey is a member of the Task Force Subcommittee on Artificial Intelligence and an associate at Debevoise. Corey practiced in the firm's Data Strategy and Security Group in the litigation department. He is a leader of the firm's Data Portal, which is an online tool that helps clients quickly assess and comply with their cyber breach notification obligations, and tracks AI regulatory developments, including heading development of the Debevoise AI Regulatory Tracker 2. Sophia and Azish, let's start with you. In 2021, you authored an analysis titled AI-Enabled Underwriting Brings New Challenges for Life Insurance, Policy and Regulatory Considerations. Your analysis was published in NAIC's Journal of Insurance Regulation. In the publication, you concluded that insurers are increasingly using novel data sources and automated systems for risk classification and underwriting. Automation has improved operational efficiencies in the accuracy and speed of underwriting, but it also raises new considerations regarding unfair discrimination. Presumably, those data sources are no longer novel. Are the data sources still the same? Have insurers expanded the number of data sources? What were the considerations for unfair discrimination? Have insurers addressed those considerations? Where do things stand now?
Well, first of all, thank you so much, Jerome, for the invitation to be here and for your leadership on the City Bar's Task Force on Digital Technologies. So I'll kick us off and then invite Sophia into the conversation as well. I wanted to share at the outset, we decided to study this issue because the Center for Ethics' mission is to identify and provide research and education relating to those areas of practice in financial services where there is either no regulation or limited regulation to help guide behavior. And back in 2020, when we first started studying this topic, it was a time of great, I'd say personally, a great turmoil in terms of the pandemic, the advocacy for social justice, particularly after George Floyd's death, and seeing the leadership within business generally and financial services specifically relating to the role of companies relating to discrimination and how there could be additional leadership in areas, particularly such as this one, where there was at the time really no regulation that addressed AI. Fast forward, not too many years later, it's been 2 or 3 years, and we have seen that the regulators in insurance in particular have actually been very proactive in identifying AI and the challenges for unfair discrimination. And we look forward to this conversation today because we have been following this really closely since we published that paper and are encouraged to see that there have been such specific regulatory responses. Sophia, I wanted to turn it over to you to start talking about the data sources.
Sure. So to your question, what data sources are being used? And we agree they're probably not novel anymore, but with the collection of data, it is changing all the time. So we're able to access more and more data as technologies advance. And we may not necessarily know specifically which data points insurers are using. They're not required to disclose every single data point that they're looking at. But because generally that's proprietary, and even how their system is set up is the algorithm itself is also generally proprietary. But Colorado actually provides some guidance here in their bill or their law where they define what's called external consumer data and information sources. And in that description, they actually give several data points that they recognize that insurers do use either in the underwriting process as far as determining pricing or even denial rates, right? Whether or not they're going to approve or deny an application. And the interesting thing is some of these data sources are ones that we may be accustomed to using. They may, of course, it's information disclosed on the application, but then it could also be things like credit scores, criminal history, background, even just court records, home ownership, and your occupation. However, it goes a little farther and it talks about some of the data sources that maybe consumers don't realize are being utilized. And some of these data sources are being obtained by marketing services or other third parties that the consumer may not even know about. And that could include browsing history, purchase history, right? Online purchase history, geolocation data. So from certain apps that are tracking locations, they could be selling that information to third parties, social media usage, and biometric data. And that one has had a lot of attention recently because it's the relationship between what my Apple Watch or my Fitbit is tracking and then how that data is used in, say, an application for life insurance. And again, consumers may just not realize that information is being used. And then we'll go back to Azish to talk about some of the risks of and the mistakes that can be made with this type of data.
Jerome, you'd asked about unfair discrimination and how that factors into this conversation relating to data. And part of what Sophia and I had researched and written about is that there is a set of mistakes that can appear within the data, the categorization data and the process of the data that can lead to unfair discrimination. And at a high level, I just wanted to highlight what we mean by categories of mistakes. For example, there might be false positives in the data. Let's say there's facial recognition technology that falsely identifies someone as a smoker when they're not a smoker. So this is not only a data risk in terms of the data input, but if the algorithm is using this input and then making inferences with respect to life insurance and its pricing, well, you could see how that would be unfair to the consumer. Similarly, there could be use of irrelevant data. Imagine someone is part of an African-American breast cancer survivor group. There's a set of considerations relating to fairness about whether or not that data source is an accurate reflection of that individual's risk. Does that say anything about the individual, and who should decide whether participation in a social media group is relevant to underwriting risk or to reaching out to consumers through marketing and whatnot? Sophia talked about the chain of authority with respect to other data collectors who are providing data to the insurance companies. And if those data providers are using unlawful data, such as race as a category for mortgage decisions, we as financial lawyers know that's prohibited, but it's not necessarily clear that the companies that are in the first instance extracting the data that goes into the algorithms, because the regulators are not necessarily reaching into those companies, they may not have the same protocols and compliance systems that is aware of these issues. So there are a host of issues that relate to mistakes, but then there's, of course, the social implications of this, right? So we're thinking about this from a social impact issue and how it relates to financial inclusion. In your introductory remarks, you noted that this technology is really important to be able to improve the efficiency and access to financial services, but that needs to be balanced with the risk of bias and unfair discrimination and how that affects different groups of consumers. So either actual consumers or prospective consumers of financial services and products. And that's where the unfair discrimination comes in. And in particular, there's an area of concern within the space related to proxy discrimination. And Sophia is going to tell us a bit more about that.
And proxy discrimination is a subcategory of unfair discrimination where some facially neutral factor is used in a decision-making process, and that causes disproportionate harm to a protected class. So when we're looking at all of these data sources that feed into the algorithm for underwriting, for example, we can see, for example, how Azish's example of the African-American breast cancer survivors, if someone donated to that organization, donation history might be in there, or even geolocation, if they're attributed to an area with a higher African-American population. The system won't necessarily classify them as a certain race, perhaps, but it could then use that as a proxy, that data point or those data points as a proxy for then saying, well, is this tied to a higher risk classification or a higher risk of mortality? And that's where the proxy discrimination can occur. So it could result in higher pricing, right, or discriminate pricing in that way, or even higher denial rate. And the difficulty for the insurance world is that the business model for insurance is based off of risk classification, right? So we need to have a way of classifying applicants in certain risk categories. The challenge is that there really isn't hard and fast definition of what proxy discrimination looks like when we're using all of these different data sources. And some discrimination is permitted, right? We're allowed to have different underwriting for men versus women because of different life expectancies. And then you add to this level of complexity, the kind of obscured nature of what happens inside. We've heard the term the black box of operations, where the insurer may not actually know what relationships the system is creating, particularly as we look down the line with AI-enabled systems, and they may grow and change over time. The difficulty is really in how do we define or set some kind of guidelines so that insurers can measure against, is unfair discrimination happening or proxy discrimination happening? And then later on, we'll talk about how they can remedy that.
Thanks, Sophia and Aziz. You also noted that AI-enabled systems raise unique ethical implications, particularly regarding accountability among AI actors. You pointed out that many insurers rely on unregulated third-party algorithm developers and do not own and may not have access to the logic embedded in the system. You then proposed a framework that consists of, one, the establishment of national standards to serve as guardrails for the acceptable design and behavior of AI-enabled systems. Two, a certification system that attests that an AI-enabled system was developed in accordance with those standards. And three, periodic audits of the system's output to ensure it operated consistent with those standards. Do NAIC's 2020 principles on artificial intelligence address your concerns? If not, what do you recommend that NAIC should do further to address your concern?
First, just going back to our model, that 3 kind of part model that we proposed in our paper, when we talk about the development of standards, you mentioned that it's development of the system design standards, which we're kind of referring to as the front end standards, and then also standards for testing the output of the systems on the back end. And in our paper, we propose that those standards should actually be developed at an industry level. So requiring collaboration between regulators, technical experts, and of course, industry input to develop a set of standards that all insurers can be measured against. Right now, we're seeing with Colorado, New York, and other proposals that are there, the standards are internally developed by the insurer, and then the insurer tests themselves against those standards. So that's a little something different that we proposed. And on the front end, that system design can be based off of actuarial best practices. But the goal is that the system should be designed so that the risk of discrimination is minimized. And those standards should be, assessed before the system becomes operational. An example of one of the, guidelines that can be provided here is how much weight do we give to certain factors over others, based on the level of potential discrimination that could occur. So if we're factoring in criminal history, for example, giving that weight some consideration when you know that criminal history does reflect bias from our historical justice system and systemic bias. So giving guidelines to insurers about how much weight they should actually place on some of these factors, taking into account the representation of bias, is essential. And then on the back end, providing the guardrails or the guidelines for testing. And we really emphasized in our paper that just because an insurer's outputs might fall outside of these guardrails or these standards doesn't necessarily mean that immediate penalization is warranted and discrimination has occurred. What it is just a flag for the insurer to do further investigation. And then they can look at what data sources did we use? What relationships was the system devising between the factor and whatever risk classifications we were looking at? And those can be, again, a flag, and then they can either justify what their use of the factor is or then go into remediation. And those standards go back to the categories that Azish was talking about earlier as far as, is the data accurate, right? So is my Fitbit or my Apple Watch really counting accurately how many steps I'm taking, my heart rate, my average resting heart rate? And then actuarial significance, which is, does that actually tie to whatever behavior we're trying to predict? So does that tie to higher mortality or lower mortality? And then the third, is the system appropriately developing the relationship between that factor and whatever target outcome we're looking for? So is it appropriately then determining what price should be, assessed, or whether or not that application gets approved or denied? And then Azish, if you want to talk about the next part of the question.
Absolutely. So since we published the paper, we are seeing some emerging regulatory models for how to address this. The NAIC has come out first with their principles, and recently in December, they have approved a model bulletin for use of AI systems by insurers. There is the New York Department of Financial Services proposed rules that we'll discuss as a panel on this podcast. And the Colorado insurance regulators as well have proposed new regulations relating to risk management of AI systems and some proposed rules with respect to testing and auditing of those systems. So I'll speak generally to the question of how this relates to the three-pronged approach that Sophia just shared, and where we see some opportunities to further evolve practice relating to these AI systems. And one is around the standards. So as Sophia mentioned, we see a benefit of having standards that are set at the level of the industry rather than for each firm. And I think the best way to consider this is that we all in business know about the gap auditing standards and the use of external auditors to be able to come in and test the books and see what's going on under the hood. They're testing it vis-a-vis a certain set of standards that are now nationally recognized as being determinative of what's good with respect to accounting. We think that there's a similar need for this issue within financial services, because without that, we wouldn't necessarily know where each insurer has decided to calibrate their own systems. And if we want to advance this to the level of financial inclusion and having an overall view towards risk, we think the standards at the national level would help. The other area is, as we're seeing in the emerging regulatory infrastructure, is that there's some different views with respect to testing. First of all, most of them do refer to it as testing and not audits. We think independent third-party audits would be the gold standard for addressing these challenges. We are seeing some different views with respect to the testing, which I think we can discuss as a panel later in this podcast. For instance, Colorado is very specific about the testing parameters and methods. They're looking at a 5% threshold that is determinative of what they think would be unfair if there is a standard that applies to a set of an individual who's part of a protected category. New York is a bit broader. They're giving discretion to the insurers to develop a methodology. They've listed a certain number of methodologies that insurers could use, but it's not clear what their view might be on what is sufficient. By giving the flexibility to their insurers, it does allow for the practice to evolve and for both the industry and the regulators to learn from it, but it also introduces this element of uncertainty in terms of the social implications and who determines where that line will be. And the other category where we're seeing that there's some divergence and perhaps a gap is relating to remediation. Colorado is very specific on remediation and refers back to the regulation that they put in place last year relating to risk management, whereas the New York law is more general, and they are relying on the existing remediation processes, which are, again, not as specific to what would fall under a category that would be violating law. There are a few other categories where we see some gaps as the laws are emerging.
So thanks, Azish and Sophia. Corey, Azish and Sophia explain in reasonable detail the guidance they published to try to help NAIC and insurers across the country to address important considerations on the use of artificial intelligence. On January 30, 2024, your firm published an analysis titled The NYDFS Plans to Impose Significant Obligations on Insurers Using AI or External Data. You are actually one of the drafters of the analysis. So before we drill down into that analysis, would you please provide a summary of the most important points your firm was making regarding the plans of DFS? Since many of our listeners are either experts in insurance or experts in artificial intelligence, but not both, what are the most important takeaways in-house counsel, compliance officers, and other independent risk managers for insurance companies operating in New York and perhaps even elsewhere must consider when you look at the plans of DFS? What is your firm advising in-house counsel, compliance officers, and others regarding what DFS is doing?
Yeah, so thanks, Jerome. And before I dive in, I just wanted to echo Sophia and Azish. Really happy to be here. Really happy for the opportunity. So thanks again to you, Jerome. Thanks again to the task force. As a bit of background, the proposed circular builds on DFS's 2019 insurance circular letter number 1, but that was limited to just the use of external data. I'm going to refer to it as ECDIS, which is not the nicest term, but it's the easiest way for us experts to sort of to refer to it quickly. But it's limited to the use of ECDIS for underwriting life insurance and focused on the risks of unlawful discrimination that could result from the use of ECDIS and the need for consumer transparency. The most recent proposed circular incorporates the obligations from the earlier circular one, but it adds far more detail requirements, which expands on the scope beyond life insurance and adds significant governance and documentation requirements. And to really dive into this point, so Jerome, you hit on this before, the circular letter does not change the underlying applicable law or regulations. All it really does is expresses DFS's opinions and guidance on things that already exist. That being said, it really does give good insight into what DFS's enforcement priorities are going to be, not just for 2024, but for the future years ahead. In terms of specific things that we've highlighted and specific things that are of note with the proposed circular, we've divided these into 3 sort of larger categories and then a few subcategories for each of them. But the 3 largest ones are governance, testing, and third-party vendor management. So just starting with governance, the subcategories that we've thought about there really are board and senior management oversight, policies and procedures, documentation, and transparency. And just diving a little bit into each of them, for board and senior management oversight, the proposed circular notes that the board of directors is obligated to oversee the insurer's use of ECDIS and AIS, which is artificial intelligence systems, and ensure that an effective governance framework is carried out. The proposed circular also explains that senior management should be responsible for day-to-day implementation of ECDIS and AIS systems. As far as responsibility goes, we've often seen when these new and emerging technologies come out that senior level board and executive management aren't necessarily involved in the day-to-day, and they don't necessarily want to take responsibility for whatever comes of it. DFS doesn't really see things that way, and they're certainly sending strong messaging that when it comes to enforcement, that's not how they're going to view these things. Relatedly, for their policies and procedures requirements, insurers using ECDIS and AIS should have written policies and procedures consistent with the proposed circular. And then these policies and procedures need to be approved annually by the board or senior management. So again, anything that's getting signed off on here, anything that a company is putting together to make sure that they're complying with the proposed circular has to be approved and reviewed by the board and senior management. Specifically for the policies and procedures, it requires that the policies have clearly defined roles and responsibilities, that there are policies for monitoring and reporting requirements to senior management, and then a training program gets put in place for relevant personnel on the lawful use of ECDIS and AIS. There has to be accountability mechanisms. There has to make sure that training is in a timely manner, that it's in a consistent manner. So all things that we've seen in the cybersecurity realm really just being applied to this space as well. In addition to policies and procedures, there are really extensive documentation requirements. And I'm sure we'll talk about this later, but this is certainly an outgrowth of what we've seen from Colorado, which my personal opinion, the most interesting and impactful thing from Colorado was the documentation requirements, and just a few important points there. So DFS in terms of documentation requires an up-to-date inventory of all artificial intelligence systems implemented for use, under development, or recently retired. So it's not just things that you're using today, but it's things that you might use tomorrow, and it's everything that you used yesterday and decided to stop. Further, you have to document a description of the process for tracking changes of your use of ECDIS and AIS over time, including a documented explanation of any changes associated, rationale for such changes, and which parties are responsible for the approval of such changes. And finally, you need a description of the data lifecycle management process. This is really old hat in a lot of sense for risk management, right? This is something companies are used to doing in terms of making sure that you have version control on things, making sure it's documented, and any change that happens to any document across an entity, we understand why it happened, who did it, and who approved it. This is really just bringing AI into that space. And then finally, and this is a bit different than Colorado. So for transparency, which is a value we've seen across the AI industry, and especially on the EU side, we've seen a lot of stress about it, but we haven't necessarily seen it codified in the US. DFS does particularly address transparency. So for example, any adverse underwriting or pricing decision that's based on ECDIS or an AIS, an insurer must provide a notice to the insured or the potential insurer, which discloses a number of different things. For example, whether the insurer uses AIS in its underwriting process, whether the insurer uses data about the person and whether that data was acquired from an external vendor. And then you have to provide the fact that any person who's on the receiving end of such an adverse decision has the right to request information about the specific data which caused this adverse decision and contact information for making that request. Anytime you're using AI and anytime you're using ECDIS and it results in a decision to somebody, you're going to be held accountable, not just from regulators, but from the individuals who it impacts as well. The other two, and I'll try to run through these a little bit more quickly, but testing requirements, and I'm sure we're going to hit on this a fair amount in our next section. DFS breaks testing down into two sort of larger categories, one of which we've talked about for a number of years now, but we haven't seen regulators discussing it. And then the other one is a little bit more obvious. So the newer one is qualitative testing, which we've always talked about as, does it pass the eyeball test? Does it pass the smell test? Can you explain why you're using a specific piece of data and how it directly links to a risk, which would make sense to impact insured? I think we talked about smoking earlier, right? I don't think anybody would deny the fact that smoking has an impact on life expectancy. That's a pretty direct correlation. That's a pretty direct one-to-one. But for example, if you say a very specific geolocation, well, if you live on this block in New York City, we think we're going to raise your premiums. The immediate question is why? Well, what does that block have to do with anything? Why is that specific block a different risk than the block next over? So qualitative testing this is, at least as far as I'm aware, the first time we've seen a regulator address this, which is frankly a really encouraging development. From a quantitative testing standpoint, and I think Azish hit this pretty spot on earlier, it's really much more flexible than we've seen other regulators take the stance, which is good and something we've been hoping to see. Every insurer is different. Every insurer handles itself differently, its business differently, its data differently, and its AI differently. So telling different analytics divisions and different analytics groups and units in these companies, you have to do it this way. You have to test things this way, especially when it's not like GAAP. There is no established way of doing this because it's all new and changing all the time. Building that flexibility in there and giving a little bit of wiggle room to the insurers to decide what's best for them, recognizing that regulators are still going to have the opportunity to review the decisions you've made, we see as a really encouraging development. One interesting question in terms of testing, and we don't actually think it's clear in terms of the proposed circular, is what actually needs to be tested and when it needs to be tested. So much of the circular puts forth a risk-based approach, which means that different pieces of AI systems and different pieces of data receive different levels of scrutiny based on the potential level of impact. So extremely high risk AI system, you really need to pay attention to. Potentially really low risk use cases, maybe you don't need to pay as much mind to. But one of the questions here is, does everything need to be tested? And does everything need to be tested from a quantitative standpoint in the same way? So the circular provides that insurers, and this quote, should take an approach to developing and managing their use of ECDIS and AIS that is reasonable and appropriate to each insurer's business model and overall complexity and materiality of the risks inherent in using ECDIS and AI. Extremely different approach from Colorado, like Azish mentioned earlier. Theoretically, the risk-based approach should allow some uses of ECDIS and AIS to be deemed low risk and maybe to not require testing, or at least quantitative testing, which, as I'm sure everybody who works in an insurance company know, it's not inexpensive, both from a time standpoint and from a resources standpoint. Again, it's only theoretical. The circular hasn't really delved into detail, and we haven't heard anything on DFS about it. So hopefully in the next round, or hopefully when they decide to hold a town hall, we can get a little bit more information there. And the last point, and I'll really just mention this one, is third-party vendor management. We've seen this sort of be, I would say, to me, surprisingly, the hot button issue, both for insurers, but just for AI generally. Unsurprisingly, most companies don't actually create their own AI models. Insurers often do because historically and traditionally, they're dealing with really large and vast amounts of big data. And when it comes down to it, their business is utilizing that big data, but being really on top of pricing and on top of underwriting, on top of marketing. From a traditional AI standpoint, some insurers certainly do make their own models. But now that we're really diving into the age of generative AI, GPT, Copilot, Minstrel, things like that, more and more companies you see are really outsourcing their use of these models. And like we talked about before, the one thing that DFS makes very clear, and I think every regulator's made this very clear, is you might be outsourcing your use of a model. You are still 100% responsible for it. And that means two things. It means you're not only responsible for any potential discrimination of a model, but it also means you're still responsible for fulfilling your obligations to DFS or to Colorado, whichever regulators. So it ends up with a really interesting nuance of, and the easiest example of this is documentation, right? So you're responsible for having a pretty hefty amount of documentation about every AI model that you use. Even if you're using a third-party model, you have to do enough diligence, you have to gain enough information, you have to get their policies and procedures and brochures so that if DFS or any other regulator calls on you as an insurer, you have the documentation in place so that you've fulfilled your regulatory obligations. I think that was a very long-winded few top points, but I'll stop there. Those I would say are the three biggest things that we took note of from DFS.
Yeah, excellent analysis, Corey. The three of you have indirectly compared Colorado and New York. And I suppose by implication, that suggests that the two of them may, at this point in time, be the kind of standard setters in terms of having a proposal out there. DFS is unequivocally one of the leaders in insurance generally across the board. And there's a lot of states will look to what DFS is doing and respond to what DFS is doing. So as the three of you think about this and you think about what DFS is doing, what Colorado is doing, it occurred to me that those are not the only insurance markets. For example, Connecticut and California have very important insurance markets as well. How do you see, if at all, that the FS model or the Colorado model will influence those other state models? And you also have, as Sophia and Azish have pointed out, the NAIC itself is also coming out with standards. So can the three of you do some comparisons so that those persons in New York and out of New York, because our audience is across the nation, kind of compare those and read in your crystal ball where you think things are going or might go when you're comparing how things are shaping up in this area with respect to the use of AI in insurance?
Sure. I'm happy to take this one first. I mean, in terms of the larger regulatory landscape, I think DFS was sort of the very large shoe that everybody was waiting to drop. Colorado came out, and the insurance regulators specifically have been a very interesting case in terms of AI regulation because, at least in my view, they've really been the one leading forward more than any other type of regulators. And we've seen white papers, we've seen guidance, we've seen just blog posts and sort of podcasts like this and people talking about it. But the insurance industry is really the first one to dive in and say, we're going to take action here. We're going to regulate this. But it's really the first time that this industry has been regulated. So we've seen, a lot of bumps and bruises and back and forths, and looking at the really early drafts of Colorado to where it is now, some really massive changes. And I would expect the same thing with DFS here. So DFS Part 500, which is their cybersecurity regulation, underwent amendments earlier this year. And the first round of those amendments compared to where things ended up, you could see that DFS really considered and took to heart a lot of the comments that went back and forth and a lot of the feedback that they heard from the industry. I would think that we're going to see a lot of the same here, in that these regulators are trying their best, but they don't know what the actual realities of the people with their feet on the ground doing the actual work. And they're not necessarily always aware of the larger implications and the pragmatic implications of what they're doing. I would say, at least based on 500, it's been really nice to see how much they've taken that into consideration. But as far as the larger landscape, it'll be interesting, and the easiest, or at least the most impactful difference between Colorado and DFS that stood out to me is, frankly, just the scope between them. So if you look at it, the proposed circular is vastly broader than the Colorado governance regulation. The circular applies to all types of insurance, not just life insurance, which is all that Colorado applies to, but it's also much narrower in terms of services. So the proposed circular is all types of insurance as it relates to underwriting and pricing, whereas Colorado is life insurance only applied to underwriting, pricing, and other insurance practices, which is marketing, which is claims management, which is really anything that helps you provide life insurance. So DFS is sort of, I don't mean this to be taken the wrong way, but in a sense, an inch deep and a mile wide, and Colorado is an inch wide and a mile deep. So they're just completely different approaches. I mean, even just looking at the scope of them, it'll be really interesting to see where the rest of the regulators go. Sophia and Azish, I'm sure you have a lot to say on this as well.
My sense is that the NAIC model bulletin is likely to be a standard setter. As we talked about earlier, there are these three models, essentially. So the two that Corey just described, with New York and Colorado having really different almost philosophies about how to approach this. And I think NAIC playing a really important role in providing the model bulletin for other states who are now learning from these examples to determine which path they want to take. Of course, the model bulletin is just that. It's a model. It's a set of rules that each state can adopt. And as I understand it, many states have already stepped forward to adopt them, but then they tweak different parts of it to be consistent with their existing laws, or to perhaps reflect a philosophy that they have in mind relating to it. So perhaps a conversation for a future podcast is to see the developments of the model bulletin and the impact that it has on the different states, and how different states have tweaked various aspects of the model bulletin. I do think, and Sophia, I want to invite you into this part of it as well, of course, in terms of how to think about, with these different models, if we take a step back and think about the challenge of unfair discrimination. And as Sophia mentioned earlier, discrimination is a core part of the insurance process. Determining what is unfair has been part of the regulatory system since insurance began to be regulated, right? In terms of understanding what is an outlier and what is consistent with good insurance practices. That's part of the regulatory process. AI is presenting new challenges, and it's pressing on the laws in ways that I think we would still like to see further develop in the insurance regulatory space that can address some of the more thorny challenges. I can understand why at the outset you wouldn't jump into the deep end in that way. But I think that as we're learning from these regulatory practices, there's some opportunity for further tweaking. What do you think, Sophia?
Yes, I definitely agree. Before we talk about those, I just wanted to address, Jerome, you asked how are insurers, what is their viewpoint? Are they just waiting to see what happens in these other states? And back 2 years ago, Azish and I interviewed people in the risk management departments or in the technology departments at several life insurance companies. And there really weren't two camps. There were the group that said, well, we're just going to wait and see what happens. And then, Corey, to echo what you said, many of them were saying, we're just going to wait and see what New York does. But some of them were really proactive and they wanted to get ahead of what they needed to do, even before necessarily their state was requiring it. So now we're seeing everyone is sort of on board, but it was interesting to see the two approaches across the industry. And then as far as things that, are additional considerations and some of the more complex issues, in our paper, we strongly advocated for independent review. So that was at the certification stage, making sure the system is set up to minimize risk and having an independent standard and certification to kind of put that stamp of approval on the system by a third party before it becomes operational. Both New York and Colorado right now are having the insurers develop those standards themselves. And then the other is, how do we get a little more into this third-party vendor management that Corey was discussing? So yes, the insurers have rightfully, the liability is on them under all of these models where they need to ensure that the third-party vendor is developing the system in compliance with what the insurer is held to the standards. And then also that the system is continuing to operate and not drifting into something unfair. However, there's really still this gap of if the insurer is responsible for making sure that the third-party system is operating properly, how can they do that if they don't necessarily have access to the data sources and the algorithm itself? Because again, that could be proprietary to the third-party vendor. And in addition to that, if the insurer is outsourcing this anyway, maybe they're not capable of doing the testing that they need to, right? Which is maybe why they outsource in the first place. So that kind of relationship between what the insurer has access to and what they're responsible for, are they responsible for doing the testing themselves, or do they rely on the testing representations made by the third-party vendor? And is that enough? Does that satisfy due diligence? That is still kind of unresolved. And maybe additional considerations in the future could be, are there specific contract rights that the law requires that the insurers have in their contract with the third-party vendors about access to specific data points or all the data points and access to testing, and just getting a little bit more so that the insurer can do that due diligence?
I think that last point's really interesting. And Jerome, I know one of the things we had discussed before is when you're talking about this with clients, what are we talking about? What are we advising? And Sophia, on that last point, one of the things that we've really been stressing is third-party vendor diligence programs, right? So mapping it and making sure, right? Because the first thought when you see these come out is, I want to map my program and I want to map my risk management framework and make sure that I'm doing everything I can to be compliant. But that's not always the question. The question is also, do I have everything that I need from the vendor to make sure that we are both being compliant? So it's building that third-party diligence, whether that's document requests, whether it's questionnaires, whether it's audit rights, like you said, whether it's testing rights, whether it's attestations from them, and just making sure if a regulator calls and has an exam, they're not going to have an examination of the third-party vendor. It's going to be of me. And do I have everything in my system ready to go so that when they call, I have a nice, neat package and I can say, we've been waiting for you, here you go, instead of frantically having to call up the vendor and hoping that they were doing everything they were supposed to be doing. it's a lot of preparing like that on the front.
And my background before I became an attorney was as an internal auditor. And that all sounds so familiar, the frantic scrambling to get us what we needed. But I absolutely agree. And that's why when we talk about the audit prong of our model, we have the internal audit side, which what you're describing is just building all of this into their own internal audit systems, right? And the governance and risk management system that they already have in place. So that should just become part of their normal routine operations. And then we also propose that there should be an independent audit as well, kind of mimicked off of the financial audit systems that we have. And I know that's kind of a challenge. It's certainly going to be a challenge at this early stage of even utilizing this technology. But down the road, really, that's the only way to minimize that conflict that insurers will naturally have, that we need to uncover our own potential discrimination and then report that out. And then independent audits can help minimize that.
I wanted to add as well a comment about the pervasiveness of AI in our lives. And data collection practices are already a part of our everyday life. In addition to social media tracking our behaviors and preferences, there's the Internet of Things that collects data within our day-to-day lifestyles through our cars or some smart home tools. And what I see in the insurance regulations is an underlying concern about data privacy. But data privacy isn't squarely within the bounds of insurance regulation. So I think what this means is that even if insurance regulation can provide appropriate constraints about how these new data sources are used, the data privacy issues about the collection in the first instance will still be an issue for consumer protection. And I think this is what makes AI regulation so challenging. It touches nearly every aspect of our regulatory infrastructure. When there are gaps like the ones that exist with data privacy, it's going to affect how AI is used and how effective insurance regulation can be for consumer protection.
Thanks, Azish, Corey, and Sophia for such an excellent discussion. So, Corey, one of the areas that we need to kind of put a bow on, and hopefully you could do this, as the three of you were speaking, there's developments on these three possible standards, the NAIC standard, New York standard, and Colorado. But there's also other states that may be exploring how they're going to do it. I know that your firm has a data portal and an AI regulatory tool, and you're a key person in operating that tool that helps to track and monitor these trends and developments. How does that work? Could you explain how your firm's data portal and AI regulatory tracker tools work?
Yeah, no, definitely. So the data portal is our internal suite of tools, mainly internal suite of tools that essentially we ran into a problem that I'm sure many law firms ran into a few years ago, which is law firms often do the same things over and over again and do the same research and have to charge for it. And it's just not the most efficient way to spend your time. So we were looking for ways to really cut down on that churn. And we came to the conclusion that legal tech is maybe not as far as it should be. So we got a little bit impatient with third-party legal tech and we just decided to make our own tools. And really, we are the developers, but also the number one users of it, right? So we built this for ourselves to make our own work more efficient. The data portal is pretty large and covers a vast majority of different things. It covers cybersecurity obligations. It covers data breach notification obligations. There's some international sections in there. It covers different enforcement actions under the cyber realm. And one of the parts of it is called the Debevoise AI Regulatory Tracker. So internally, we just call it DART. And I think DART started a few years ago. And what we realized was you have all of these different regulators from all over the country that are posting all of these different things about AI, and they don't seem to overlap, at least on a visual level. So you could be looking at two regulations that talk about the exact same thing, and you could put them next to each other, and it would look like they were in different languages. And it could just be from two different US states, or it could be the SEC versus the FTA. And for us, we're having a really difficult time doing comparisons between them. So instead of doing that, essentially what we did is we figured out what we thought were the 15 or so sort of universal categories that these things were covering, whether it be audit rights, whether it be data privacy, explainability, transparency, regulatory actions. And we broke those down, and we now basically in real-time access track every regulatory AI development globally to the extent that we can. Anytime a draft comes out, we take it, we have a lawyer sit there, break it down into our model, which has the standard uniform categories, and then we upload it into our tool in a searchable platform. So there are over 100 different regulations or proposed regulations, blog posts, speeches from different SEC commissioners and things of the sort. And at least that way, it's not really an apples to oranges things anymore. It's an apples to apples. We have some clients who we've granted the ability to access it directly for a fee. I think they've decided that they deal with these questions often enough. They don't need to pick up the phone and call outside counsel anymore. They can just type in a URL, but that's our process. And again, I think I said it before, is it really vital to the work that we do internally as far as an incentive goes to make sure it's as up to date as possible and accurate as possible. There's nothing like relying on it yourself.
Yeah. Thanks, Sophia, Azish, and Corey, for addressing these very important artificial intelligence and insurance issues and providing guidance to market participants and stakeholders. We look forward to your participation in the next podcast hosted by the Task Force on Digital Technologies. Have a wonderful day, everybody.
Thank you for listening to this episode of the New York City Bar Association podcast. Opinions expressed are those of the speakers and not necessarily of the City Bar. If you enjoy this podcast, please like and subscribe wherever you listen. Find more City Bar podcasts on Apple, Spotify, YouTube Music, iHeart, or at our website at www.nycbar.org/podcasts. Be sure to check out This Lawyer's Life, a professional development podcast where we talk with lawyers about seizing opportunities, learning lessons the hard way, and about what makes them tick. And don't miss Building Belonging, a podcast that embraces authentic conversations about DEIB solutions by amplifying the most marginalized voices in the legal industry and exploring spaces others dare not. This podcast was produced and edited by Eli Cohen.